Welcome back, everyone. Today on the Joseph Carlson Show, we have another huge video with lots of companies' earnings. We've already seen an update of what's gone on with Hims and Hers stock. This company had its shares plunge after earnings. They fell 22% in a day. It went off to around a 30% sell-off, and that was 2 days in a row. Now it's back to $41 per share. It's having a nice little bounce back. We're going to be talking about what went wrong with this earnings report. There was one part of the earnings call that really caused the sell-off. We'll be going over it. We also have some other companies, ones that are in my portfolio, large concentrated positions, like Intuit. This is one that reported yesterday and the stock is up 13%. We'll be going over what's causing such bullishness in this stock. Now, just today we had Salesforce report its earnings and it's down 4.5%. It immediately sold off. The bots and traders did not like this report. They came in shy on their revenue and their forecasts. We'll be going over the Salesforce earnings report, the commentary, and the future of this company. And of course, we also have the highly anticipated Nvidia report. The numbers are out and traders don't know whether to sell this one or buy it. The stock is moving from 2% in the red to 3% in the green to back in the red by 5%. We don't know what to do with it, but we're going to take a look at the numbers and see if we can figure it out. So we have a lot of earnings reports to go through. We'll be giving context and numbers to that. And we also have some news. Amazon just announced Alexa Plus, this new $20 a month subscription. It's for AI Alexa, but it's free for Amazon Prime members. Andy Jassy went on an interview and talked about it and what it does differently. We'll be looking at this in the advances that Amazon's making. And there's also a report that 1 billion people are watching podcasts on video. Not just listening on audio, but they're watching on video. And this is a long-term trend that I've seen play out with a preference for video. We'll be looking at the transition and how this impacts different companies like Amazon Prime Video, Netflix, YouTube, and Spotify. So we have a lot to get to in this episode. Let's go ahead and start off with the big news, the one that everybody's looking forward to, which is Nvidia. Now, before we jump into the report, I just want to do a little flashback, just a brief flashback into what I said about this company just a couple days ago in my predictions. We have the prediction video here, and I'll just play just a few seconds of it with my thoughts going into this Nvidia earnings. And I believe investors should lower their expectations. I think it's going to be more mundane than investors expect. And I think the data proves this. I think it's going to be more mundane. I think investors should lower their expectations. Towards the end of this, I further clarify, right towards the end of this segment. Let's skip to here. So I expect a very strong report. I expect earnings per share beats, revenue beats, continued strong guidance, but I believe a lot of that is already priced into the stock. That was my thoughts going into this one. I thought that Nvidia is going to be a company that does fine. I think it's a great quality company. It's growing fast. It's in fact incredible, the speed of growth, but there's already so much priced into this company. So the reaction from the market should be rather mundane. Analysts have already caught up to the stock. Now, when we look at the report here, Nvidia sales grew 78% year over year. This growth is just staggering. It's incredible growth. What did Nvidia do? Did they beat on their earnings per share and revenue? Yes, they beat on their revenue by a substantial amount, well over $1 billion. They had 39.33 billion versus 38. They had earnings per share of 89 cents versus 84. A beat on the top and bottom line. They're even giving good forecasts. So everything across the board is fantastic for this company. When we look at some of the numbers here from Nvidia, they are staggeringly good. The record quarterly revenue of 39.3 billion is up 12% from Q3. Now, that's from Q3. So sequentially, revenue's up 12%. 12% is faster revenue growth than most companies grow in a year. And Nvidia just did that in 90 days. In a year, they grew 78%. Record quarterly data center revenue, that's the biggest part of the company, that grew 16% from Q3, up 93% from a year ago. Nvidia is a data center company. The commentary from Jensen is obviously super bullish. Demand for Blackwell is amazing as reasoning AI adds another scaling law. Increasing compute for training makes models smarter, and increasing compute for long thinking makes the answers smarter. AI is advancing at light speed as agentic AI and physical AI set the stage for the next wave of AI to revolutionize the largest industries. So they're looking at this grandiose picture of AI revolutionizing everything. From a quick glance at Nvidia's report, it's almost impossible to find any faults from the guidance to the recent quarter, the performance, the commentary from the CEO. Everything looks good top to bottom. If you're an Nvidia investor, you're not going to be dissuaded from the stock because of this report. but it also illustrates the power of expectations in the market. That as good as these earnings are, they were expected by investors. The stock is flat, trading down slightly now. It might be up after the call. Maybe there's some comments that spur a little bit of excitement. But overall, you see the issue here. For a stretch of time, Nvidia was posting earnings that were surpassing investors' even wildest expectations. And that time period of surpassing those wild expectations seems to be over. The stock is now more fairly valued. It's a company that is now meeting investors' expectations where they are, not outperforming them. Nvidia's stock price today is now the same price it was back in June of 2024. So it's been some time trading around this same range. With the expectations already baked into this company, I see more natural organic compounding like most other stocks. Overall, a strong report for a fantastic company. Now let's go ahead and move on to Salesforce. Now when I jump into Salesforce, we see that it's down after hours. That's never a fun thing. It's down $10, minus 3.4%. It's actually coming back a bit. After Salesforce reported its earnings, it was immediately down 6%. So it's working its way back to the green. And after looking at this report, I would not be shocked. In fact, I wouldn't be surprised at all if Salesforce is in the green tomorrow. Salesforce had really bad headlines. We look at it here. Salesforce misses on revenue, issues disappointing guidance. Not good. And it's true. The revenue came in shy. They had $2.78 of earnings compared to $2.61, so they beat on their earnings per share. Unfortunately, they came in just shy on revenue, $9.99 billion compared to $10.04. Now that's a small miss on revenue, but it is a miss. Revenue increased 7.6% from a year ago in the quarter ending in January. That is the issue with Salesforce, is the revenue growth is slowing down. And they reiterated that the revenue growth is slowing down by their guidance. The market's trying to work out the fact that Salesforce is now a slower growing company, no longer growing in the teens, but growing in the high single digits. The 7 to 9% growth is okay, but it's still more of a mature feeling company. When we look at this in the actual report, we see a lot more highlights that I think give context. They had $900 million in data cloud and AI annual recurring revenue. That's up 120%. So the segment of their business involving AI is growing rapidly. Since October, they closed 5,000 Agentforce deals, including more than 3,000 paid. So they're closing thousands of Agentforce deals, the majority of them being paid. That is a major thing that investors wanted to look at. Are they able to push out this new product? Are they able to charge money for it? Does it have a high retention rate? Do their customers like it? These are going to be questions that they'll answer on the call, but this is, I think, one of the biggest deals for the company. They also highlight on here that help.salesforce.com, Agentforce has handled 380,000 conversations, achieving an 84% resolution rate, with only 2% of requests requiring human escalation. These numbers, a lot of people frankly just don't believe. They think that Mark Benioff is making it up. Because if you can resolve 84% of customer inquiries with a bot, the industry norm is that bots in most cases make people upset and they need to talk to humans. So if this is correct, this is a massive opportunity for Salesforce. And the story needs to be painted here that this can really push Salesforce in the future. Now, this fourth quarter, the downside was the revenue growth, and that's the same with the guidance. They only grew revenue by 8%, 9% on a constant currency basis, and they're guiding for 7 to 8% growth next quarter. So investors are now pricing in that this is a bit more mature, slower growing of a company. I invested in Salesforce knowing that it's a more mature company with a slower top line growth rate, but they're expanding margins rapidly. The story of Salesforce is the story of a long-term secular grower that can grow faster than the speed of inflation, but also rapidly increase margins, pushing out high amounts of profits and free cash flow. For example, in operating cash flow, they had $13.1 billion in 2024, that's up 28% year over year. Free cash flow of $12.4 billion, up 31% year over year. So they're growing free cash flow rapidly. In their consolidated statement of cash flows, we see Salesforce having net cash provided by operating activities of $3.97 billion. They had capital expenditures of only $154 million. That nets out to around $3.8 billion in free cash flow. Now, we look at $3.8 billion and we put that in context. That cash flow is well above where it was 4 quarters ago. We go back 1, 2, 3, 4. It was 3.26. So this quarter, year over year, they went from 3.26 to 3.8. Huge upgrade in cash flow once again. And even now, just looking at the stock over the past couple of minutes, it went from minus 3% to minus 1.5%. When we look at the valuation of Salesforce, it's noted that it's a slower growing company, but these are surprisingly high yields for a company of this quality. Salesforce still has massive distribution, huge customer base. They're implementing AI, they're pushing up margins, and the company trades at a 27 PE, a 4% free cash flow yield. That's just not an outrageously expensive price for a company like this. So this wasn't an amazing report, but I think it was good enough to support the stock where it is. Now finally we get to a company that did have an incredible report. It's one of my largest holdings in my portfolio, which is Intuit. Now in my portfolio currently, Intuit's a $70,000 position, $69,500 to be exact, and $17,700 of that is gains. $7,000 of that gains is just from today. The stock is up 13% on the day after reporting earnings yesterday. Now, this is a company that when we look at the earnings report and what actually happened here, it shows you how powerful of a company this is. Some people accuse me, they say, Joseph, it's like you're running an ad for Intuit, right? I'm a paid advertiser for it. I'm not. I haven't received a dime from Intuit. I'm not paid in any part or affiliated with them. I'm not trying to advertise Intuit. I just think it's a great company. I think it's a great investment. That's the reason that I've put so much of my own money in the stock. When we look at this company, there's just a couple things that I'd point out. One of them is just the revenue growth. When we look at the revenue growth of Intuit, last quarter it grew by 17%. The revenue growth accelerated. Over the past year, it's grown 13 to 14% overall, and then last quarter it upped to 17% growth. Now, again, there's tech companies like Salesforce growing 8 to 9%. Then you have tech companies like Intuit growing roughly twice as fast. This is a fast-growing tech company. Not only that, their growth is highly profitable. They're a super profitable, fast-growing company. The free cash flow increased by 88% year over year. They're exercising incredible operating leverage. So they posted free cash flow of $1.04 billion. Compared to 1 year ago, it was $550 million. Free cash flow up nearly double, while stock-based comp is up 5%. They're barely growing in the amount that they're paying employees, the amount of new employees they're bringing on, and they're increasing their cash flow nearly double. While they're doing this, they're paying a growing dividend. So this is a company that can continue to raise the dividend at rates of around 15 to 16% per year. Last quarter, they paid out $300 million in dividends, and they bought back $717 million of stock. That's in a single quarter. And that marks their biggest quarter of return of capital to shareholders ever through the company's history. On the call, Intuit noted how they're leveraging AI in every single thing they do, making all of their products more advanced, easier to use, cheaper to use for the customer. They're expanding their total addressable market, moving upstream with TurboTax, and Credit Karma has been growing incredibly fast. Credit Karma is a fast-growing portion of Intuit now. So this company has multiple levers to pull for growth. And that's why it's going to continue to grow around 13% while keeping costs low, while keeping margins high. This is another company that I'm excited to have in the portfolio. I said it was only a matter of time until investors move this stock up as the intrinsic value continues to march up. And when you see a stock where you can look at the quarterly trailing 12 months of free cash flow per share, you can just look at this one chart and see it move up 20% year over year, 18% over the past 2 years, 19% average over the past 5 years. That's a company that's going to move up in stock price. This 19% free cash flow per share growth is the reason that this stock has doubled over the past 5 years. If they continue this growth rate, there's no reason it shouldn't double again in the next 5. Now, next we have a stock that reported earlier in the week on Monday, which is Hims. The stock Hims and Hers. Now, I said going into this earnings report that I didn't necessarily believe Hims and Hers was overvalued. It all depends on the growth trajectory and what this company does. Because when I looked at the stock, it's at an $8 to $10 billion valuation, and they could post $300 to $400 million of free cash flow this year. In that case, the valuation's not extreme. That's pretty well in line with a lot of other companies. Now, Hims stock has been a roller coaster ride for the past week. In fact, if we zoom into just the past 5 days, it is down 37%. It had these massive down days after earnings. Investors did not like something they saw in the earnings report cause this big sell-off. Now, I have to note that if you zoom out just 1 month, it's up 37%. So this is one of these extremely fast-moving, highly volatile companies where 1 week it's down 37%. You zoom out only 30 days and it's still up 37%. It's crazy the moves this one gets. But when we look at Hims, there's a specific reason this company went down off of what was decent earnings. Across the board, the growth rate was in line, The earnings per share were in line, but there is a piece of commentary that really gave uncertainty in the company, and that was on the earnings call. We have the CEO of the company commenting here. This is in regards to the GLP drugs. He says, quote, "I would suspect that we will have to start notifying customers in the coming month or two that they will need to start looking for alternative options on the commercial dosing. But I would suspect, just being very direct, that a lot of those patients will try to get into the open market and try to secure a branded option in some form factor. I think that transition is going to have to take place and has been built into our guidance that Yemi provided." He's telling shareholders directly that they're going to inform their customers that they have to find different options for the GLP drugs, because Hims and Hers are no longer allowed to make the compounded version. So they simply can't offer the drugs. Now many of their customers will have to either choose between Hims and Hers' other weight loss drugs, their other weight loss methods, or name-branded GLP drugs offered by the big pharmaceutical companies. And with that question, how many people are going to stick using Hims and Hers? How many people are going to use the alternative medications for weight loss instead of GLPs? A lot of analysts have looked at this and said that Hims and Hers are very optimistic about their guidance. Hims and Hers management is saying that a lot of their customers are going to experiment with their other weight loss drugs. They'll be able to capture some of that market. But the analysts are saying, we don't think so. We don't think that many people are going to use the other alternative weight loss drugs. They're just going to go with the GLPs, and they're going to get it through the pharmaceutical companies. So this is going to be a huge loss of revenue for Hims and Hers. It was one of their major growth paths, one of their major anchors for the company. It was something that they advertised at the Super Bowl, and here they are notifying customers that they're going to have to find a different solution. So even though the report overall by the numbers was great, and even the guidance was good, the guidance is somewhat questionable, and that questionable unpredictableness of the stock is what caused the drop. But again, I would note, even with the drop, even with it selling off 36% in the past week, it's still up 37% in the past month. Year to date, the stock is up 67%. So this thing is all over the place. Right now, Hims and Hers is an interesting, fast-growing subscription company with a lot of uncertainty in its business operations in the future. Now, moving on, we have news that Amazon officially launched their new AI assistant. They're calling it Alexa Plus. It's considered a premium product. They're advertising it for $20 per month, or it's included in your Prime membership. Now, in this interview, Andy Jassy explains what Alexa Plus is.
Well, we're really excited to announce Alexa Plus today. It's our next generation of personal assistant. She's smarter, she's more capable, she's more useful, and you can do all the things you've been doing with Alexa for 10 years, but just every single one of those functions gets better with generative AI, the way we built it in. And I'll kind of give you some ways I've been using it myself, playing around for the last few weeks to give you an idea of why I like it so much. You know, I'm a big music fan. You and I have talked about this before. So the other day I was trying to remember, I went to the opening night of the Guns N' Roses Use Your Illusion tour in 1991 in Alpine Valley, Wisconsin with my college roommate. And I was trying to remember who the opening act was for it. And so I asked Alexa, and she reminded me it was Skid Row. She said, "Do you want to play Skid Row?" I said, "Maybe not." I did want to play a Guns N' Roses song, but I wanted to play the song that I couldn't remember the name of. I said, "It's a song that has the word apples in it." She's like, "Bad apples, do you want to play it?" I said, "Yes." Like that's, think about that versus what Alexa's been. She wouldn't have known the opening act. She wouldn't have known when it was. She wouldn't have been able to get Bad Apples from Guns N' Roses. So, much smarter, takes action.
It's basically just AI integrated with Alexa. Now, it seems like Amazon's actually doing this. In fact, in their blog, they outline specifically what it's capable of. Alexa Plus is going to be conversational, engage in natural, flowing conversations that feel genuine. It understands context and meaning, creating seamless interactions with no precise Alexa language. So you don't have to talk like you're phrasing things for a bot to interpret. You can just talk to it. Alexa will learn from you. The more you use it, the more personalized it gets, understanding everything from your favorite entertainment to your family's dietary preferences, allergies, and weekly traditions. That goes from being cool to a little creepy, like it learns everything about you, but either way, that could be useful. Alexa Plus acts on your behalf, handling everything from date planning and gift shopping to travel arrangements to study help. From simple tasks to complex projects, it provides an assistant you can trust. Alexa combines a vast amount of knowledge with approachable personality, making generative AI feel natural and accessible. Helpful intelligence ready whenever and wherever you need it. Amazon released a demo of what this thing can do.
So we can just, talk now.
I'm all ears, figuratively speaking.
Cool. Do you know how to manage my kids' schedules?
I noticed a birthday party conflicts with picking up Grandma at the airport. Want me to book her a ride? Billie Eilish is in town soon.
No way.
I can share when tickets are available in your city.
Yes, please.
Got any spring break ideas?
Somewhere not too far. Only if there's a beach and nice weather.
Santa Barbara is great for everyone. I found a restaurant downtown I think you'd like.
What is Santa Barbara known for?
It has great upscale shops and oceanfront dining.
Can you go whale watching?
Absolutely. Want me to book a catamaran tour?
Wow. What's the next?
You know, they always do this. In every example of AI usage, it's always vacations. Like you're going to go and have your home tablet just plan a vacation and book it for you. I don't know if people are actually doing that. I don't know if you could. Are you really going to just talk to a speaker and say, hey, I want to go to Santa Barbara, just plan a vacation and book it, and have it pay potentially thousands of dollars without really doing detailed research into it? They always show these examples. I don't see a lot of people really booking vacations through their Alexa speaker, but it's trying to show off the potential here. And what I see through this is what Apple Intelligence is trying to accomplish. It looks like Amazon has beaten them to the game. Amazon is getting to AI before Apple is. In an interview a couple months ago, Jeff Bezos said that Alexa is going to get a whole lot smarter soon. And hopefully this is it. Hopefully we get a real smart AI assistant from a speaker. I think overall this would be a really good thing for Amazon. Now finally, we get to this news that video is becoming the preference for most people even when viewing podcasts. 1 billion people are watching podcasts on YouTube every month. The video site has leapfrogged Spotify to become the most popular podcasting platform in the US. YouTube first identified podcasts as a popular content and format during the pandemic. Before then, the medium wasn't something that YouTube had specifically supported. Podcasters were organically coming onto YouTube and users were flocking to their content. YouTube dedicated employees to the effort, ensured podcasters could sign up for the platform's ad services, offered more robust analytics, and recommended more podcast content to viewers and listeners. Those endeavors vaulted YouTube past Spotify technology, which helped define the podcasting boon when it invested more than $1 billion into acquisitions and licensing deals for popular shows. You'll know that they purchased Joe Rogan for like $100 million. So Spotify has been paying their way to do this. YouTube has been growing it organically. In 2022, after investors grew wary of Spotify's profligate spending, the music streaming company shuttered its in-house podcasting studio, reducing headcount and significantly paring back its podcast efforts. Around the same time, YouTube began offering as much as $300,000 to podcasters to entice them to create video versions of their shows. So Spotify is pulling back so that they can generate free cash flow. They need to create margin by pulling back on these expenses, just as YouTube is enticing people that only have audio versions of their podcast to make video versions, knowing that it's a medium many people gravitate to. The YouTube podcast trend existed, but it was a matter of us pouring some gas on it. Podcasters are now able to tag their content as such, helping YouTube's search algorithm to surface the programs to more people who already consume podcasts. YouTube wants to continue to improve ways for podcasters to make money and to support multiple languages so the show can be consumed around the world. So I don't see this as some short-term trend. I see this as a long-term secular trend. It's proven that people prefer video over audio only. We're seeing that in podcasts in and of themselves. The companies like Netflix, Spotify with Spotify Video, Amazon with Amazon Prime Video, and especially YouTube are the best positioned to capture this growing market. I'm invested in many of these companies, but this type of news just makes me more bullish. That's all for now. See you in the next one.